Real estate is a long-term finance and management proposition. You've got to get good at management if you're going to be successful. Also, equally as important, you've got to secure a solid source of financing. Less money down equals more deals, more equity, more net worth, more cash flow, all of those good things. Now let's examine a deal. Let's pretend that we bought this deal right here. This is our house that we found. We're buying it for $55,000. We're buying it at a discount. It's going to cost us $20,000 to fix up this house because it's a distressed home. And because we're putting this sweat equity in it, it's actually going to be worth $100,000 ARV, after repair value. Okay? So what that means is when we sell this house or when we retain it as a landlord, it's going to have $25,000 in equity minus whatever closing costs are initially when you buy it. Now there's different ways you can finance this, and let's examine some of those different techniques. Now the first thing we think of when we think financing is we think bank financing, right? That's where we go to get money. That's what our parents did. That's what our brothers and sisters do when they get real estate loans. And that's the first place that a real estate investor looks when they're new. Here's how bank financing works. They're going to make you come with a 20% down payment, okay? And that's based off of either the appraised value of the home or the purchase price, whatever happens to be lower. So they're not actually giving you any advantage for buying a distressed property. So 20% down, we know, is $11,500 because we're buying it for $36,000 or for $55,000. They're going to make you pay the closing costs too. They're not going to roll that into the loan, unfortunately, but that's going to be roughly $5,000 for your title and all your underwriting fees and all those things associated. Now, they're not going to lend you money for repairs. Banks don't do that. So you're going to have to come up with that out-of-pocket cash. You're going to have to pay the general contractor $20,000. So basically, you add all those things up, and your out-of-pocket investment on that deal, if you're going to buy it, is $36,500. That's your investment into the real estate transaction. The bank finances the rest. So your return when you go to sell that is $25,000 minus closing costs, so that's $20,000. Now, when you're looking at financing, the best thing you can do is you need to look at it in terms of ROI, okay? Return on investment. Now, all we do is we divide this number into this one to determine what that is. I put $36,500 into this investment. I got my initial my initial investment back, and I made $20,000. So what did I make? I made 55% on my money. So that's not a bad day of investing. Now, here's some other advantages and disadvantages of bank financing if you do go to a bank. You're going to get a low interest rate. Very, very low. You're going to get a long term, so you don't have to worry about paying this loan back right away. You can get a 30-year fixed term with most banks. Here's one of the bad parts. Banks require an inspection. So if this property needs $20,000 in repairs and it doesn't pass this inspection, they're not going to finance it until those repairs are done. So you may have to go back to the seller and try to get them to do that. And if you're buying it as a foreclosure, it's just not going to happen. So that financing isn't going to work in that scenario. Here's one of the big parts too. They don't allow double closes or assignments. So at least 50% of the good deals that come into your email box that you find out there are from wholesalers or flippers, and they double close or assign the property to you. So you're eliminating 50% of the houses that you look at that are okay for this financing. But one of the biggest disadvantages of using bank financing is there's a 30 to 60 day period in order to close that loan. And when you're buying these properties from motivated sellers, from banks that want to get the assets off their books, they're not going to be too excited about you taking 30 to 60 days to finance this property, because potentially you could burn up all that time and the financing could fall out. So they're going to want to go with a cash buyer or somebody that uses a different type of financing that can close in 5 to 10 days. That's more secure for them, and they'll probably take a lower offer in order to have that assurance that it's going to close. Another type of financing you can use is called hard money, okay? It's also called rehab loans, it's also called bridge loans, all those things. But at the end of the day, what it is it's money that comes from a private source, specifically for real estate investors. One of the disadvantages of this is it's got a high interest rate, okay? Another disadvantage is a short-term loan. Unfortunately, you can't have your cake and eat it too. It's a high interest rate, it's a short-term loan, and the reason it's a high interest rate is because it's a short-term loan. They know that you're going to have this money back to them within 90 days or something like that. So they're going to need to make more money on the transaction versus a 30-year loan. One of the very nice things about it is any condition is okay. They know you're going to buy a distressed property, so they're okay with the house that needs a lot of work. The other nice thing is the repairs, they're actually going to be included in the loan. You're not going to have to come out of pocket fully for those repairs. But the biggest advantage is they're going to be able to close that deal in as little as 5 days. So when you make that offer, it's going to be a very strong offer, and chances are you're going to get that contract versus the other people that have bank financing. Now, hard money financing works a little bit different than bank financing. It's actually more congruent with an investment property versus a home that you're going to live in. The way hard money lenders work is they lend you approximately 70% of the after repair value. So it doesn't have anything to do with the purchase price. And the nice part about that is the lower you're buying the property for, the bigger discount you're getting, the less money you're going to come to closing. So the way this works, we're going to lend 70% of the after repair value, ARV, and remember that was $100,000, so the loan is actually going to be $70,000. And let's look at what you need on this deal. You need $55,000 to buy it, you need $20,000 to repair it, and you need $5,000 for closing costs. Well, we're going to roll that all together, and that's $80,000 is what you need to do this deal. You're going to get a $70,000 loan, so you just come with the difference. So your total investment, your total down payment that you come with to closing with is only $10,000 on this transaction. Your return is going to be the same, roughly. You know, you're going to spend a couple extra $100 in interest payments over the course of the 3 months. So, but your return is going to be roughly $20,000. So your ROI, return on investment, in this scenario, you spent 10 and you made 20. That's a 200% ROI, much better than 55%. This is why investors choose to use this type of financing, irregardless of the higher interest rate or the shorter term of the loan. Less money down equals more deals, more net worth, more cash flow, more profit. Now, if you're a flipper, here's where the advantages are really going to become apparent. If you look at it with not just ROI, but actual money in your pocket. If you're flipping and you buy one house with bank financing and it takes $36,000 to get the deal done out of your pocket and you make $20,000 in profit, you can do 3 of those houses with a hard money loan for less than $36,000, $10,000 a piece, and you can make $20,000 on each one of those, and that's a $60,000 profit. This is why I say less money down equals more deals equals more profit. Now, if you're a landlord, this principle is more true than in any other type of investment. If you're buying from the bank, you're going to spend the same amount, $36,000 down. You're going to have $200 a month in cash flow and $20,000 in equity. Why wouldn't you buy 3 of those houses and get that equity capture 3 times? $10,000 down on each one of them, less money out of pocket again. And what you're going to do with the hard money, with that high interest rate, you're just simply going to do a rate and term refinance, up to 75% of the new appraised value of the property. Now keep in mind, the repairs are done, and this property looks great now. Okay, so bank financing will work now once you've fixed it up. Now there's going to be a cost to refinance. It's going to be about $2,000 to $3,000 per property. So you're not going to have to come with that out of pocket, but you're going to roll it into your loan. It is going to reduce the equity you have in the property down to $17,000 from $20,000. But you have 3 of them now, so your equity is much higher, $51,000 versus $20,000. Now, debt reduction is a very big piece of being a landlord. This is the long-term part of real estate. Debt reduction is basically when a tenant pays off your mortgage for you over time. So if you used bank financing initially and you were only able to buy one of these houses, after it was paid off, you'd have $100,000 in equity, and your cash flow would go up to $1,000 a month. Now, where you get the most bang for the buck, less money down allows you to buy 3 properties and refinance them, and the debt reduction on 3 properties would give you a $300,000 equity spread or net worth in those properties. In addition to that, you would have 3 times the amount of the appreciation, and you'd have 3 times the amount of the cash flow in these deals. So your cash flow would actually be $3,000 versus $1,000. Remember, less money down equals more deals, which equals more equity, more income, more appreciation, and a much higher net worth.